All right, well, we'll start right on the dot. Thank you all for attending this month's monthly market update webinar. Start with disclosures as usual. Silverstone Financial LLC is a registered investment advisor. Information presented is for educational purposes only. And of course, all past performance is not indicative of future performance. There's lots more disclosures. You can check out the website for them. Throughout the webinar, please post any Q&A questions using the button below. I'll address them at the end. And if you have any personal questions, you can email me. I'll be happy to get back to you. All right. Quick summary about me. My name is Jeremy Eppley. I'm a chartered retirement planning counselor, accredited portfolio management advisor, and accredited investment fiduciary. You can learn more about my credentials and experience on my LinkedIn. And Silverstone Financial is a fee-only fiduciary RIA. We specialize in wealth management and financial planning. You can learn more about us on our website. So there have been a couple changes to Silverstone Financial that if I can take a couple minutes before hopping into market news. One of the big, exciting, honestly proud moments was that last month, Silverstone Financial joined XY Planning Network, NAPFA, which is the National Association for Personal Financial Advisors, and the Fee Only Network. All three of them are prestigious advisor associations that require any firm or advisor part of them to be both fiduciary and fee only. And it helps elevate our status and allows us to be seen by more eyes by being part of those networks. So very proud that we were accepted and joined those networks. Another thing, if any of you have recently visited the website, slight revamp. I worked pretty hard on making everything a little nicer and easier to understand. The pricing was changed slightly, and the services and pricing page overall should be easier to navigate and understand. I try and take pride in the transparent pricing. A lot of advisors you'll go to won't have pricing on their website. I'm not saying that we have anything particularly special or about average. We're not the cheapest, we're not the most expensive, but overall it should be easier to understand now. A couple other bigger news other than just changing how stuff looks is we're now offering tax filing and estate document drafting. Both of those are in partnership with third parties. The tax filing, now that I'm part of XYPN, they have a sister company, XY Tax Solutions. And in partnership with them, now I can prepare, well, I would not be preparing your taxes, but I would have oversight in the process and be able to see the forms be created and have some insight and some hands in the process, essentially, of preparing your taxes. Also for the estate document drafting, that's with trust and will. Anyone that needs a new will update or power of attorney or trust, anything like that, I have partnered with them to be able to offer that at a discount. And the biggest update is the wealth management bundle, where everything for one fee is all included: financial planning, investment management, but also preparing and filing your taxes and creating your trusts and wills instead of having an accountant and an attorney and a financial advisor. All of that is now in one cohesive experience. So pretty proud of all of that. Enough about Silverstone Financial. We'll hop right into the normal market events. So Q2 earnings season has been very interesting to watch. It has been somewhat mixed, but mostly positive earnings surprises, which is good to see. There were a lot of fears that came about with inflation, slowing economy because of Fed rate hikes. But overall, I would characterize the earnings season as positive. However, there have definitely been some losers. If any of you hold either Amazon or Meta, which they used to be known as Facebook, or have followed any of those news articles that I'm sure have been posted around. But both of them had rather disappointing quarters. Essentially, both of them had to deal with overspending, overhiring, reduced guidance. So that's expectations for the future, essentially. And in a month, Amazon dropped 17% and Meta dropped 30%. And both of them are at 52-week lows. It's really been terrible for the mega cap tech names, which are usually considered bellwethers, considered to be the safe haven in the markets, and it's really shaking up what we see now. So it's kind of making a whole, I'll say, shift in the market to reevaluating what we consider safe. And there's more movement into traditional value companies, financials or the industrials or whatever industry would provide lower costs, essentially, instead of paying high price for the same amount of earnings, but just growth potential. And growth is now no longer top of mind because we expect growth to slow with the slowing economy. Inflation was slightly worse than expected, but remember, this is September's inflation that was released in October, and now we're discussing it in November. So it's always important to remember that a lot of the inflation data, a lot of the economic data is all backward looking. So it's not necessarily what's happening today, but it was 8.2 in September, and we expected 8.1, we being analysts. And so slightly worse. We're hoping next month's release, so that comes out in a few days, which would be for October's data, will be 8.1 or better. We'll have to see. Elon Musk purchased Twitter. Doesn't affect most of us, most likely. However, there were a long legal battle in the past year, and it was definitely big financial news to see it finally go through. We'll see if Twitter improves or falls to the wayside in popularity, but I wouldn't be surprised in 4 or 5 years if it goes back and becomes public again. We'll see if that's at a higher or lower price than what Elon paid for it. Political news, Rishi Sunak became the UK's new prime minister. He was the finance minister before. It's interesting to see that development. We'll see if that helps their economy, and we will see if that has spillover effects to the rest of the ex-US economy and the US economy, because of course globalization makes even elections in other countries affect our markets. Lula is another one. Lula won the Brazil's presidential election. We will see if that has much of impact. Not many of my clients are heavily invested in Brazil, but there's still some exposure to emerging markets, which Brazil is a major market there. And no Federal Reserve announcements happened in October, but there's still plenty to say about it. For those of you who come back every single month, I'm sure you recognize this screen. But expectations have really got a stranglehold on the markets. And I honestly don't know what more to say than I have already. It's kind of a scary time to have just a handful of people, the Fed committee, control the market. It's essentially what they're going to decide is going to be the biggest impact on 2023, 2024. They're having a meeting today and tomorrow. They're having their announcement tomorrow, so November 2nd. And it's widely expected, almost 95% expectation, that there'll be 75 basis point hike. Expected, I still think most likely a mistake, but not an economist. We'll see. Hopefully the Federal Reserve doesn't over tighten. You can see last month's recording. I have it on my website and my YouTube that explains why I was rather worried of over tightening, and I still have those fears. We'll talk about this month's performance in a couple slides, and it was positive, but I think it won't last. At least this increase in market performance, increase in prices, increases risk at the very least. If we have really bad Fed essentially action, it's hard to categorize them as good or bad because it's backward looking. We won't know until 6 months from now or 12 months from now. But if the market sees what the Federal Reserve is doing as overly hawkish, which means tamping down on inflation too much, then we could definitely see some further pullbacks in the market. But I'll cover that in a future slide. As expected, tomorrow, 75 basis points. December is 50 basis points, but it's possible they'll slow down at 25 and then have another 25 in January. They could do 50 and then 25. They're very hawkish. That's the expected outcome. And that means in the spring, we'll have a peak rate of 4.5, 4.75, and they'll probably hold that there for almost a year. And we will see how that affects the economy. It likely, I am now in the view, because they're shifted their policy to a very hawkish one where tamping down inflation is number one, their number one concern. I think we're going to have a recession. I don't know how bad of a recession, but I'm concerned with the Federal Reserve's action. Year-to-date performance, anyone that's new here, this is how I see the market every single day. This is a heat map. The larger the square, the more valuable the company, the larger their market cap. The more red, that means they've lost, the stock has underperformed. The more green has overperformed. Anyway, for year-to-date 2022, we see still the global economy, which over here, 26% loss, is underperforming significantly US markets. The US markets have come back strongly in comparison to the rest of the globe. And it's because of continued failure in economic policy in other countries. I was in last slide just saying that I'm worried about our economic policy, but that kind of speaks to how bad it is in the rest of the world. The European Central Bank is even farther behind than the Federal Reserve. There's a whole lot of problems in the UK right now with the previous prime minister and their tax cuts in an inflationary environment. But that's just Europe and the UK. There's plenty of problems in China and other economies across the world. We also still see mega caps underperforming. So those are the big tech bellwethers that we see. Meta is down 72% for the year. Amazon down 40%, Tesla down 35%. I don't know if I could call Tesla a bellwether, but still a very large company. Apple performing the best, Microsoft second best, and Google performing all right in line with Microsoft and Amazon. But Meta is really the shocker. I don't know if I would consider it a shocker, but has really underperformed, down 72%. That's kind of crazy. They were over $1 trillion. Now they're a 200 something billion dollar company. And it's mostly because of their overspending and slowing revenue growth and such. Talking about just last month's performance, we see a great month. We see a very green month across the board. And I'll get to it in a bit, but I don't necessarily think we'll see that continue in November, unfortunately. But other than just the green, we see bright red spots with Amazon, Tesla, Meta, TSM, but that's Taiwan Semi. So that would be fears due to China's recent political movements that there might be a war there. And we also see all the Chinese stocks, Alibaba, JD. I won't go through them all, but essentially recently Xi Jinping, if I pronounce it correctly, has gotten his third term as president, and the Chinese markets were not particularly excited about his policies toward capitalism is shifting to a more communist state, which is not good for at least markets and those large companies. Last month, it's a very interesting historic month. October was the Dow's largest monthly percentage gain since January of 1976. It was a great month. We see Dow Jones almost 14%. It's crushing it. It's beat the S&P 500 by almost 6%, and it beat the NASDAQ, which is shown here, but even more so. The NASDAQ is weighed down heavily by these large tech companies, but you can see the NASDAQ and the mega cap stocks are nearly the same indice. Mega cap only up 5%, but it's only up 5%. Small caps were in line with the Dow Jones. Small caps, there was a shift there where there's we saw that overselling in the past few months of these small cap names. And essentially that's just rebuying of those names that were unfairly, in my opinion, beaten down. Small caps aren't inherently riskier. It's just most of them are less covered, and therefore it's safer for many money managers to just sell a lot of them instead of figure out which ones are right to hold and which ones are right to sell. We see the global economy or global stock market performing significantly worse than any of the rest of the US markets, which isn't surprising, but it's a continued trend. Bonds remained about flat, lost 1%. Not too surprising. Rates are still rising, but bonds are becoming more attractive with rates in the 4% for a risk-free rate, 5-6% for some corporates. Shifting some money to bonds is potentially a good investment depending on your specific situation. Gold has remained an interesting outlier, not keeping up with inflation, but rather following commodity deflation, which is an interesting. I've discussed it in length in previous webinars, but seeing gold down while everything else is raging is very interesting. Personally, I think gold might be. It's hard to value gold. It's hard to say it's undervalued, but it's an interesting counter trend that doesn't make sense for the rest of the market. So gold might be an interesting place to seek some value, but I have said that for the past 8 months, and for the past 8 months it's gone down. So maybe don't listen to me on that front. Crude oil rebounded a little bit. That came after Saudi and OPEC plus oil production cuts, not surprising, which caused a lot of the energy stocks to perform quite well. And Bitcoin has traded mostly flat. I know 5% isn't flat, but for cryptocurrency, it's pretty flat. It performed a little bit better than last month, but in general, it's been trading in a range. And it's kind of interesting to say that Bitcoin, in some ways, in comparison to other currencies or other commodities or other investments, however you want to classify it, is one of the more stable ones. It's interesting to say that. And we will see if that continues, if the range is broken out, or if it continues to stay within that $18,000 to $22,000 range. I showed this, I believe, this chart for the first time last month. This was after we had the terrible September month, and I was trying to illustrate that markets are cyclical. And this shows the average monthly return for the past, since 1950 to 2017. And September is on average the worst month. October is on average an okay month, and this was an anomaly. Normally, November, December, and December are great months, especially after an election. Usually, if there's an election and then the houses, the House and the Senate and the presidency, they're not all controlled by one party when there is difference in holding of the power. So no one can pass lots of legislation, make lots of changes. That's usually when the stock market rallies the most. The stock market likes homogeneity, like not lots of changes. They like to understand what can be expected of them in the next years to come, so they can make adequate investments. Lots of changes makes markets afraid. So I kind of expect that we will see quite a rally in possibly December after elections, but November, I wouldn't be surprised if we gave up some of the rallies that we saw this month. I think that'll be better explained in the next slide. So this is year to date, or actually 1 year chart of the S&P 500. And I had shown this a couple months ago, explaining whether or not we had touched a market bottom. This was discussing right here, our June market bottom. Did we touch it? And the answer is technically no. We retried it in the beginning of October and broke through it. And so officially that wasn't the market bottom. However, what we see now is considered a range. So we see a floor being put in, and will that floor hold? So 3,600 about is where we stopped. And I wouldn't be surprised, again, if that floor holds. I wouldn't be surprised if we retest it in the future, especially if we have bad inflation data. It's possible we break through it slightly, but I don't see lots of huge spikes or drops like what we saw in June. Those spikes and drops that were coming about with a lot of what was happening in Ukraine and such, now it's a lot about what we see the Fed do and what we see inflation actual data when it comes out. And inflation data isn't going to shock us by huge numbers. Usually it's, oh, we're off by a little bit. And that will cause slight adjustments in the markets. So I wouldn't be surprised if we trade sideways and volatile. And that's not a fun thing to say or a fun thing to experience when you're not making any money and you want to be out of the market, because why trade sideways when you can just stay in cash? But oftentimes across the board is not a recommendation I can give unless your specific situation requires it, because we don't know when we'll finally be ready to take off. This was if you had sold the bottom of June and missed all this recovery and then bought up here, you would have really had a terrible time, because this would have been down to the 3,600 level. I forget the number. I had done the math before the webinar. I apologize, but you'd be down almost 35% or something if you hadn't stuck through the market. So I'll reiterate, usually it's not recommended to try to time the market. Staying in it is oftentimes the best you can see. I also want to talk quickly about this little dot I put here. This was when the Federal Reserve made their very hawkish announcement. And then in September 1st is when I kind of railed on the Fed and said that they're making a mistake. And the markets traded exactly how I was saying. They had the same sentiment as me. They were thinking that markets would continue to fall if the Federal Reserve followed this path. So far, the Federal Reserve has followed their path, and it is expected that they're going to show resolve and they're going to continue to follow their path tomorrow when they have their announcement. If they do that, I think this will be the ceiling. Unless the Federal Reserve surprises in some way, breaking out significantly is not extremely likely. I'm not saying everything's going to crash or anything like that. And again, whenever I say, I think it's important to note in finance, when you're making a guess or when you're predicting something, it's 65% chance is a really good chance. It's almost always closer to a coin toss than a certainty when making a bet in finance. So when I'm saying it's very likely, that's maybe 65% chance that the Federal Reserve is going to do nothing shocking, and that will cause the market to sell off at least slightly and give up some of the gains and probably return down to the 3,800 or so level. So we'll have to see. I will cover it in depth next month, what they say, but stay with caution. Don't invest more than you need to, but also don't sell off. It's very dangerous to miss out on the rallies. Again, missing out on this rally is not fun to have. You want to make sure that you are getting the upside alongside the downside, not just the downside. I've discussed with some of clients and prospects and such that the intentions to sell off in the markets, and that's why I've repeated a few times. I would think twice about leaving the market. Staying through it all, even though it's uncomfortable, is usually the better move. All right, I know I rambled a little bit there at the end. Hopefully that came across in a way that is easily understood, even though this is difficult to predict the future, even with a rather complex chart. So if anyone has any questions, I'd be happy to answer them. I have at least one coming in about, let me make sure I read this correctly. Okay, it's about international elections and such, and how that might affect it. Essentially, it's a question about if they really do have a big effect. I might have overstated it slightly on how big of an effect, like Lula's presidential election, that probably won't have a huge effect on our markets. The UK Prime Minister will likely have a larger effect, especially on his policies, depending on if they have a strong UK economy. If they can have some solid growth, then that can have a lot of positive impacts for our economy, because the UK is a big trading partner of ours. But I wouldn't say Lula winning the election or the UK Prime Minister being elected as either a buying opportunity or a selling opportunity. The number one driver of this market is the Federal Reserve by far, and what they decide. And so far, I don't have the greatest confidence in them, but a lot of the fundamentals in the market are still solid. I'm positive, or I am optimistic is the better word. I'm optimistic that even if the Federal Reserve over tightens, which I think they will, the markets will be okay. So I think that was the only question that I can. There is another question that was more personal that I'll send you an email for, but those are the only two questions that were received. If anyone else has any other questions, I'd be happy to answer them. But if not, I hope you have a great rest of your night. And I hope I'm wrong for November, and we do have a great next month. Again, we have our great cyclical market structure that we can hope that this will stay true, and November will be great. But oftentimes when you have extreme outperformance in one month, you're going to give up some of the gains in the next month. It's just usually how it works. All right, leaving you off with disclosures, and I hope you all have a great night. Yeah.